Did you know that in the early 1900s, Wall Street didn't have the sophisticated tools or systems we take for granted today? It was more like the Wild West of finance, and one young man with a photographic memory and a knack for numbers saw it as his playground.
Oh, I love that image. Chaos, inefficiencies, and someone like Benjamin Graham stepping in to make sense of it all. It's hard to imagine the father of value investing starting out in such a raw, unpolished environment.
Exactly. And that's what makes his story so fascinating. Graham didn't just adapt to the chaos, he thrived in it. He started out as what they called a statistician, which was really just an old-school term for a securities analyst. But even then, he wasn't just crunching numbers, he was questioning the very logic of the market.
That's what set him apart, right? He wasn't content to just accept market prices as gospel. He wanted to understand the underlying value, to find the cracks where the market got it wrong.
And he found plenty of those cracks. One of his first big realizations came in the bond market, around 1914. Back then, the big question was solvency. Could a company pay its debts? But Graham went deeper. He discovered these strange anomalies, like bonds from the same company where the better bond, higher coupon, senior claim, was somehow trading cheaper than the worse one.
That's such a wild concept. It's like finding a $20 bill on the ground while everyone else is walking past it, assuming it's fake. Graham saw those opportunities because he was willing to dig where others wouldn't.
And he didn't stop there. One of his early triumphs was the company G Arbitrage. This was classic Graham. The company was planning to spin off shares of 4 other firms, and when he did the math, he realized something incredible. The combined value of those 4 stocks was actually higher than the price of Company G itself.
Which is just mind-blowing. The market was essentially saying, the rest of Company G is worth less than zero. It's hard to believe people didn't catch that.
Well, that's the thing. Most people weren't looking. But Graham? He saw it as a golden opportunity. He bought Company G stock and short-sold the equivalent amount of the 4 underlying stocks. When the spin-off happened, he used the distributed shares to cover his shorts, locking in a profit no matter what the market did.
And it worked. It's such a clean, elegant strategy. But as we know, success in the market is never a straight line, and Graham's next chapter would be a brutal lesson in humility.
Oh, absolutely. By 1916, Graham was on top of the world. He was earning $50 a week, a huge salary for the time, and even managing money for a Columbia professor who trusted him with $10,000. Life was good.
But then came 1917, and everything fell apart. First, the stock market crashed, wiping out the professor's account. Then Graham's brothers were drafted into the army, leaving their record store. Yes, Graham and his brother had opened a record store on Broadway, in the hands of a manager who turned out to be a thief.
And if that wasn't bad enough, Graham got hit with a margin call he couldn't meet. He had to liquidate his positions at the worst possible time, losing almost everything. Newly married and deeply in debt, he hit rock bottom.
It was so bad that Graham even considered suicide. But what saved him was the kindness of that Columbia professor. Instead of demanding immediate repayment, the professor worked out a plan. Graham would pay $60 a month until the debt was cleared.
It took over 2 years, but eventually the market recovered, and the account was back in the black. That experience left a lasting impression on Graham. It taught him the absolute importance of a margin of safety, a lesson that would become the cornerstone of his investment philosophy.
And during those tough years, Graham also started writing. In 1917, he published his first article, Strange Anomalies in Bond Prices, in the Magazine of Wall Street. It was a modest start. He earned $25 for the piece. But the ideas he laid out would go on to define value investing.
He argued that the market isn't infallible. It makes mistakes, and those mistakes create opportunities for investors who are willing to dig beneath the surface. He even used a simple example of 2 tobacco bonds to illustrate his point.
One bond had a 7% coupon in a senior claim, while the other had a 5% coupon in a junior claim. The market irrationally favored the junior bond because it traded at par, but Graham showed, with basic math, that the senior bond was the better investment.
It was an early glimpse of Graham's genius. He was already thinking about concepts like discounted cash flow decades before they became formalized in academia. But he was still young, still learning, and the 1920s would bring a whole new set of challenges and temptations.
The Roaring Twenties. The market was booming, and Graham was riding the wave. In 1919, he even published a book called Lessons for Investors, with the subtitle, A Good Investment is a Good Speculation.
Which is so ironic, considering the Benjamin Graham we think of today. But back then, he was still figuring things out. In one article, he even fell into the trap of price anchoring, arguing that low-priced stocks had more potential to double than high-priced ones.
It's a reminder that even the greats start as novices. Graham had to make mistakes to learn the hard way before he could become the disciplined investor we know.
By 1920, Graham was a junior partner at his firm, making a solid income with no personal liability. But he wanted more. He wanted independence.
And in 1923, he got it. A raincoat magnate named R. Harris gave him $250,000 to manage, along with a $10,000 salary and a 20% cut of profits. Graham left his firm and started the Graham Corporation.
It was a bold move, but it paid off. He was finally his own boss, managing money during the greatest bull market America had ever seen. Of course, he had no idea that the greatest test of his life was just around the corner.
And that's where we'll leave it for now. Benjamin Graham's early years are a masterclass in resilience, curiosity, and the relentless pursuit of knowledge.
If there's one takeaway, it's this. Legends aren't born. They're forged in the fires of failure, hardship, and the willingness to learn. And Graham? He was just getting started.